Hey gang, in this video we're going to talk about double declining method. So buckle your seatbelts on and keep those thinking caps on because this one is a doozy. By the end of this video you'll be able to master it with no problems. But first, facts. So thus far we have already mastered how to properly calculate straight line as well as units of production depreciation amounts at the end of the period. This video is here to introduce you guys to the double declining. And fair warning, of the 4 depreciation methods, this one is the monster. But don't sweat, I got your back. Double declining is also considered an accelerated method. Why? Because this method, based upon the calculation, gives you the highest depreciation expense in the earlier life of the asset. And then as time goes on, it decelerates to smaller amounts. And so with double declining, there's a 2-rule process that you must master in order to calculate the correct rate. First, you have to calculate the depreciable rate. The depreciable rate is simply taking the number of years of the useful life of the plant asset and dividing it into 1. So if we have a truck that has a 10-year life expectancy, the depreciable rate would be 10 divided into 1, which will basically give you 0.1 or 10%. Once you calculate the depreciable rate, step 2 tells you that because it's a double declining method, you have to double the rate. So if our depreciable rate for that truck was 0.1 or 10%, we must double it, which will give us to 20%. Once you have this rate, you can then utilize this as a base to calculate the depreciation expense for each year. But under double declining, there's some other rules that you must consider, gang, and I strongly suggest that you calculate this by using a table. I think we're going to transport right now to the board with a clear visualization of an example of how to create the table so that you can finish the double declining method of depreciation. Let's go. Okay, gang, we're going to take a look at this beautiful illustration of how to properly calculate the depreciation expense under the double declining method. On January 1st, It's a Joke purchased a private jet for $40 million. It's a Joke expects the jet to remain useful for 6 years, 3,700,010 miles, and to have a residual value of $4 million. The company expects the plane to be flown 1 million miles in year 1, 200,000 in year 2, 500,000 miles in year 3, no miles in year 4, 2 million miles in year 5, and 10 miles in year 6. Okay, so first things first, we have a 2-step process for double declining. Step 1 is to calculate the depreciation rate. We know the depreciation rate is simply just taking the number of years of the useful life and divided into 1. Therefore, our depreciation rate is equal to 6 divided into 1, which will give us roughly about 17%. Then we are instructed to move on to step 2. Step 2 tells us because it's double declining, we're going to double that amount. If we multiply that times 2, that will give us 0.333 or 33%. So for our first year's depreciation expense under double declining, gang, we always use the book value for the calculation. And so at the beginning of year 1, our book value was 40 million. So we're going to debit depreciation expense / plane for the $40 million, which is the book value, times the 33%, which we just calculated. And that's going to give us $13,200,000, gang. And so, of course, we're going to also credit accumulated depreciation / plane for the same amount. And that is how we calculate depreciation expense for year 1. How about we now take a look at a proper depreciation table so that we can see the effects of depreciation throughout the life of this asset. And so here is a beautiful example of a depreciation table under the double declining method. So remember, gang, each depreciation method has its own different table, which consists of various columns. In the double declining method table, we start off with our book value. Book value will always be the base for the calculation. And book value is always cost minus accumulated depreciation. Now, double declining is a slippery snake of the methods because a couple of things must be noted. It's an accelerated method, which means that the highest depreciation expenses will come in the earlier years. So, at the beginning of year one, the book value is $40 million. We're going to multiply it times our depreciable rate, and that should give us a depreciation expense for year one for $13,200,000. Our accumulated depreciation value will be equal because this is the first year that we're depreciating the asset. And our book value will be cost minus accumulated depreciation. So if we take the 40 million and subtract it from the 13 million too, that will give us this year's book value. Again, using book value for the calculation at the beginning of year two, our book value is now $26,800,000. We're going to take that and multiply that times 0.33, and that's going to give us $8,844,000. Remember, to calculate our current year's accumulated depreciation value, we must add up all of the depreciation expenses thus far. So if we add up year one plus year two's depreciation expense, that'll give us a total of $22,044,000. And in terms for book value, we're going to still take the $40,000 gain and subtract it from the current accumulated depreciation. That'll give us $17,956,000. So we're going to do that for the other remaining years. And so I want us to pay attention to both the accumulated depreciation balance as well as the book value at the end of year 5. And as you can see at the end of year 5 gain, our accumulated depreciation is $34,599,500, as well as our book value being $5,400,500. Here's the deal, gang. Accumulated depreciation is slowly creeping up to the full amount that this asset could be depreciated, which is $36 million. So we need to keep an eye on that because we cannot depreciate it more than that on next year's depreciation. What about book value? Well, if we can only depreciate the asset up to $36 million, that leaves our book value to have an amount of $4 million left. And so we can see that the book value is almost depreciated up to the $4 million. So basically, gang, the most that we can depreciate is $1,400,500 in the following year. And so if we take our beginning book value of year 6, which is $5,400,500, and multiply it times 0.33, we see that the depreciation expense would be $1,782,165. And we know that's too much, gang, because the most we could depreciate this asset is $1,400,500. And that will properly give us accumulated depreciation of $36 million. Which will give us the correct amount of our book value of $4 million. And so this is something you have to keep in mind as you calculate the double declining method, is that you can never depreciate it past its salvage value. So there you have it, gang. A beautiful illustration of how to calculate depreciation expense for the year, as well as create the depreciation table under the double declining method. Hopefully that light bulb was clicking upstairs and you got the punchline, and if so, please like and subscribe and share the channel with your friends so they can chase that bag as well. It's always my pleasure to have you guys, and I'm truly appreciative of your time. Hope to see you soon. Bags.